Today we'll be talking about some potential ways of reducing down your taxable income if you have a high income. My name is Daniel Passon. I'm one of the tax consultants at Robert Hall & Associates, and we're here to talk about how to reduce down your taxable income if you have a high income. And hopefully by the end of this video, you have a better idea of how to possibly lower your taxable income if you are in a highly compensated job. First off would be to increase your deductions. Secondly would be to talk about a fee simple donation plan. A third topic, if you're a highly compensated person, high income, would be to just try to lower down your tax exposure and mitigate what you are having exposed to via possibly other investments. I mean this because if you have dividends or interest on your taxes, that's just going to be additional income that you're going to be paying taxes on. Even if you have qualified or long-term capital gains, these are things that will lower your taxes because they are lower tax hits, but maybe you could have those invested into maybe state and municipal bonds or other items that possibly might have no tax if they are within your state where you reside. These are things that when you're highly on W-2, these are topics that you might be able to lower your tax exposure, since there's not a lot you can do as a W-2 person. You can put money into a 401k, you can put money into an HSA, health savings account, you could put things in maybe deferred comp, and these are items that might lower your W-2, but these have limitations and that you can only put away so much a year. So those are things that could help on just the dealing with this side of the equation. These are the three topics I would say we could talk about if you're a highly compensated person on W-2 to lower your taxable income. As always, please like and subscribe to our channel so you can be updated on any future videos we may post for you. So if you are a highly compensated individual at your job, you have probably three topics for today that we can touch on to see how to lower your taxable income. First off, you can increase your deductions. Now, I say increase your deductions not in that you have more taken out of your paycheck, because as much as that is increasing your exemptions, thus how much is coming out of your paycheck, that is not necessarily increasing your deductions to lower your taxable income. Now, if you lower your taxable income, your taxes will drop too. And if you increase your deductions, that's a means to help lower your tax. Now, deductions you could potentially lower are things like your tax, your charity, and potentially your itemized deductions, at least on the state level. Unless the tax code changes in the near future, as they had prior to the Trump administration, you were able to also deduct job expenses on the federal side. But as of this recording this video, that is not the case. Now, if you were to increase your tax, there is a limitation of $10,000 currently, which has to do with your SALT, your state and local taxes. That would be your registration on your vehicles, your property taxes, as well as what you pay to your local state in taxes. That does cap currently at $10,000. If you are not at that $10,000 limit, then you might be able to increase your deductions to get to that point. Another thing is charity. Now, it is good to be charitable. It is good to be philanthropic in the world. That does not mean that you're getting back dollar for dollar. But if you do feel strongly about your local organizations, or you have a family member that you can assist through the process, then giving money to charity or to charities could definitely lower your taxable income, thus giving you back a portion of what you're giving away. Now, it is a percentage. So at the end of the day, if you do give $10,000, let's just call it, to a charity, that will probably get you 30 to 40% potentially of that money back as a deduction, or in tax savings, I should say. So yes, increasing your deductions will help, but there's not a dollar for dollar necessary reflection on that on your bottom line. Another item in the future and or past were job expenses too. Now, these are things that can lower your taxable income at a limited amount on the state level if you are in California or other states that have state income taxes, but federally they are now disallowed. Another topic is also regarding for the deductions. Another area is if you do have the side jobs where you're self-employed, or if you're able to have any of those jobs get paid to you via self-employment, Schedule C, sole proprietorships, you can use those expenses, the additional deductions, to help lower down your income. Because as a self-employed person, you're able to deduct things directly off the top. Whatever's ordinary and necessary for what you do, you can lower your income and thus greatly reduce down your taxable income. The next topic would be an area like a fee simple. Now, a fee simple is a little bit on the more aggressive side of tax, but it is an area where if you give money into a fee simple plan, you're able to deduct and get a large charitable donation on your taxes accordingly. These are things that are appreciated assets. Thus, they allow you to take a large deduction off your taxes at a rate of 30% of whatever your adjusted gross income is. If you're, say, at $250,000, that means that you could have about $75,000 or so, give or take a little bit. I'll use better math. $500,000 would be $150,000 of a charitable donation. Now, it is 30% of your adjusted gross income. And in that same scenario, you're going to get probably 30 to 40% of a deduction off of that item. Now, a fee simple item is something that would help your taxes and would lower you down, but it is an appreciated asset situation. So if you were to invest into a group, a plan, then you can have that deduction be based on what your investment is and then the appreciation of that investment. If you'd like to know more about this, please reach out to a tax consultant or reach out to Robert Hall & Associates so we can give you better information, as it is a little more complicated, but it is a powerful tax tool as well. A third topic, unfortunately, would be to be appreciative of your income and just try to mitigate your tax liability as best you can. As a W-2 person, you can take things like your 401k deduction as a adjustment of your taxes, maybe an HSA, health savings account, or possibly other deferred compensation. These are things that lower your W-2s, but lowering your W-2 is going to help you only so much because there are limitations and maximums that you can do. So if you have maximized everything out and you've done what you can, don't have any side jobs, can't increase any of your deductions anymore, then now it's just trying to figure out how you can best lower your tax exposure. Now, that would be items like possibly maybe you put your investments into lower taxable things like state and municipal bonds. State and municipal bonds, as long as they're within your state, are potentially tax-free. They might not return the same investment, but they are going to lower your taxes. So questions and interested in having an appointment with myself or one of my associates, please go to our website, www.roberthalltax.com. Reach out to us and we can be sure to assist you further.